Hey, welcome back, Market Rebels. Well, that was a fun day. If you didn't see it, we closed up quite a bit there. I think it was over 400 points going into the close, but pretty much straight up off the opening bell. But it kind of gave me a good idea for today's presentation because so many people think, God, if I could just tell where the market was going, if I could just tell if it was up or down or sideways, I could make so much money. And they spend so much time trying to figure out where the market's going. I'm not saying that doesn't give you an edge and wouldn't be nice to know, but it's not as easy as you might think. And to make the point, we're going to talk about that with the value of perfect information. So I want you to just kind of imagine for a moment that we do have a perfect crystal ball and that we do have perfect information. And let's just say that I didn't see the exact close, but the Dow closed somewhere around 32,820 bucks. And the question is, how much would you pay to know the exact level of the Dow in 30 days? All right, so I want you to think about that and think about it hard. What would that be worth to you if you knew exactly where it was going to close? And if you don't like the 30-day mark, pick a time, 60 days, a year, whatever. But on some specific date, you know the exact level of the Dow. What would you be willing to pay for that? Now, if you ask most people, they'll say, oh my gosh, that would be worth millions, hundreds of millions, and almost an infinite number because we would have perfect information. All right, so I want you to jot down your number that you would be willing to pay or that you think that somebody would be willing to pay. So let's say we're in an auction and we're going to get a high bidder. What do you think would be the value? So jot that number down and let's take a look and let's say that it closes at exactly the same level. Now, what are you going to do? Well, now people are going to say, well, okay, that's not so bad because what I could do is I could sell naked puts. Well, we never said what would happen in the interim. What if the Dow falls 20% first or more? What's going to happen? Now you could end up with a massive maintenance call. Your broker might shut the position down no matter how convinced you are that it's going to bounce. And you end up locking yourself into a loss, even though you knew exactly where the Dow was going to go. See, it's also path dependent. It's not just about the dependency or what the value will be at expiration. Well, what if we said, all right, well, what if we sell naked calls? Same problem in reverse. Dow might rise first, put you into a massive maintenance call. And then again, the broker closes you down and now you're locked into a big loss. Plus you paid a boatload of money for that perfect information. Well, what if we give ourselves a hedge? Maybe we could sell vertical spreads. Well, you have to meet the maintenance requirement. Remember, everybody thinks that when you sell a spread that you just get this nice big fat credit to your account. Not true. You have to pay the margin requirement equal to the difference in strikes. So ultimately, even credit spreads are debit spreads. So you're still going to have to meet a maintenance requirement. And will you be able to sell enough spreads to make up the cost of the information that you just bought? See, there's a lot of issues that go into this whole idea of saying, well, here's where I think the stock is going. What should I do? See, we get asked that a lot here. And by the way, for those of you who didn't know, we're starting Coach's Corner. This Thursday will be our second show at 4 p.m. Eastern. And these are some of the topics we talk about where coaches get asked, oh, I feel like the stock is going here. What strategy should I do? It's not an easy answer. And that's part of what I'm trying to show you here. It's not as easy as people would think. Now, of course, you can go like some websites do and say, oh, it's easy. If you think the stock is going up, you buy calls. If you think it's going down, you buy puts. Absolutely false. That's going to get you hurt. It's far more complicated. Options are deceptively simple, but they are far more complicated than people give them credit for. Now, here's one of my favorite examples from way back, and a stock that's now defunct, but it was called Atherogenics. And let's say we've got our crystal ball again, and we get this reading that AGIX, that was a ticker symbol, is going up. Now, at the time, there was this new heart medication that was coming out, and a lot of buzz in the markets about that. So here's what most people will do. Right? I think the stock is going up, or in this case, I've got perfect information. I know it's going up. What do we do? Well, like most people, you say, let me buy a call. So they look down the list over here and they say, eight's too much for an option, six, this one looks pretty good down here at 480. That's really how most people pick their strikes. And they'll say, oh, I didn't spend too much on the option. False. See, these are all things that are easy to believe that are just dead false. But let's do it. Let's say that, again, we've got this perfect information, the stock's going up, and we pay $4.80. Now, was our crystal ball right? Well, here's the actual quotes. You can see this is from back in 2004. So this was, the stock went up in 6 days, right? From September 16th to the 22nd, it went up 13%. Now think about that. Most stocks don't do that in a full year. 13% in a year is a big move. 13% in 6 days is unheard of. This is a massive, massive move. All right, so now what we have to do is say, how did we do? Well, we paid $4.80 for the option, and we could sell it on the bid for $4.70. We lost 2%. People are going, wait a minute, how did you lose 2% when we had perfect information that the stock was going up? This is why you have to understand volatility. Now, at the time, if you had gone and looked at a volatility chart, we would have seen that the maximum was about 70, low is down here at about 35 over the past year, and currently it was at about 55%. So you, at least for people who are in the coaching classes and the Q&As, know that that is, if you had to pick a number, that would at least be a good starting point of what we can expect for the next 30 days. So let's do that. Let's take 55%. We'll go to a pricing model. Now the stock was 1881. The strike we were looking at, the one we chose, was 20. Number of days to expiration happened to be 29 days. The volatility that we feel is 55%. Interest rates at the time were almost 2.5%. We choose calculate, and look at that. The model is saying that the option's worth 70 cents. 70 cents. What did the market want to charge you? $4.80. So now what we have to do is work the problem backwards. Over on the right, we can use what's called the implied volatility calculator. We can type in the market price of the option, which remember is 480. What we're saying now is that's a known. We know that that's the market price. What volatility would be necessary to make that market price true? In other words, what number would I need to put over here to make this price 480? This is just a little shortcut down here. You choose this calculate button and look at that, 250%. That's why I like this example. It is one of the most extreme examples I can remember ever. Showed up on a kind of a little volatility radar that we had, and that's why I created these slides for it. So take a look. There's the last year. Where do you see 250%? All right, so we got to zoom out a little bit. There it is. There's 250%. You are up into the stratosphere. And you have to be aware of that before you take your decisions. You can't say, I think the stock is going higher, let me buy a call. We have to also say, what's the point spread? If you want to make a sports analogy. I've talked about that before. If you're betting on a football game, you can't just say, I think this team is going to win and go drop a bunch of money at Vegas, because you have to say, it's not about if you think that team's going to win, it's do you think they're going to beat the point spread? And that's really what we have to do here. Are we going to beat the 250% volatility? If you think they can, that's a long shot, good luck. The better bet is that we're going to see mean reversion and that it's going to fall. So keeping that in mind, we think we're bullish, right? Because that's what the crystal ball told us. But we also have a feeling that the volatility is going to collapse. So now, being a better options trader, we understand we have to take delta and gamma at a minimum. So we know that a long call has positive deltas, right? Acts like long shares of stock, but it has positive gamma. Those deltas are going to increase as the stock goes up. They're going to decrease as it comes down. Long puts have negative delta, but they also have positive gamma. A lot of traders get that wrong. They say, well, if I have a put because it's negative or bearish, that it must have negative gamma. No, it doesn't. You paid for it. You have the right to walk away. That's positive gamma. Well, think about now, we got a little bit of a dilemma. I'm bullish, but I'm not betting that it's going to be a fast, aggressive move. I'm betting on it to be either mean reverting or at best zero. I don't want positive gamma. Well, how can I get that? Well, what if we shorted the put? See, now we're going to flip these signs. Now we're going to have positive delta and we'll have negative gamma, exactly what we wanted. So would that have worked as a strategy? Now, I think most of you know we don't recommend this at Market Rebellion, an outright naked put. I'm doing it just to make the presentation easier, but this would be a possibility. So let's go take a look. Let's go back to those quotes. Here is a put. If we shorted the put at 550, we could have bought it back for 390. See, look at that. It's not enough to just think that the stock is going up, or in this case, even if we knew it was going up. We have other moving parts with options. Now, sometimes people will say, oh, if the volatility is high, just sell options. It doesn't matter what you sell. Well, what would have happened had you sold the call for 440? You would have bought it back for 510. See, there you were correct for selling the option and taking the short volatility or the short gamma, but you were wrong about the direction. You got to be right about both. We saw this one. If you bought the call for 480, you sold it for 470. There you were right about the direction, but you were wrong about the gamma. You were wrong about the speed. What else could we do? Well, if we didn't know, we could also just take the stock. Stock has what? Delta 1, gamma 0, so we know that would have made money. That would be a possibility. What else could we do? Well, if we understand stock replacement, we understand our options theory, we could go deep in the money, get away from that extrinsic value, just build up those deltas, which is what we wanted. So I didn't unfortunately shoot the screenshots deep enough here, but what if we had gone fairly deep in the money, let's say with a 15 strike for 670, could have sold it for 730. There's a winning trade as well. Why? Because we have the direction and the speed right. It's not just about thinking that the stock is going up, or in some cases where people say, I absolutely know it's going up. When you start working with coaches, you'll see it's deceptively simple to think that's the way to trade options. And that's why so many people get frustrated, because they go, I was absolutely right and I lost. And then they think it's because the markets are rigged. It's not. It's because you're not accounting for all of the factors that move an options price. And so I hope that at least gives you a little bit of a perspective. There's actually more moving parts behind this, but at least that can give you the idea and get the main message across. It is far more than just being sure of the direction of the stock. So for anybody who would like to take their trading to a higher level, take that performance up, we'd like to offer you an absolutely free, can't beat the price, right? 30-minute one-on-one coaching assessment. You can talk to one of our world-class coaches. You're going to see Stu again on Thursday for Coaching Corner. But I mean, think about that. It's free. They'll talk with you about any topic that you want, but you would be surprised when you're speaking with a world-class coach of the information that they can dump into your head in 30 minutes or an hour. So if this was a complete eye-opener in 10 minutes or whatever it was, think what would happen if you worked with a professional for 6 months or a year. The things that you would learn. So it's just something to think about. If not, we invite you to keep coming back to Trading Tune-Up and get some great information that way. And once again, please join us on Thursday, 4 p.m. Eastern Time on the closing bell for Coach's Corner. We'll have more kind of similar topics, and we hope to see you then. Thank you so much, everyone.